Imagine entering a trade where everything suggests it should be profitable, and then, within seconds, the market turns against you. Why? Because only one indicator had changed, and you did not notice it at all. Today, we are going to take a deep dive into one of the most important economic indicators, an indicator that has a direct impact on the movement of global markets, and especially on the Forex market. Even if you are a trader who relies entirely on technical analysis and does not usually trade based on news, understanding this data is absolutely essential if you want to approach the financial markets professionally. These indicators are, in fact, the compass of the economy, the tools through which you can better understand the market's true direction. So do not miss this video. Let's begin. Let's start with one of the most important economic indicators in the financial markets, the indicator that is always used to measure the economic strength of countries, Gross Domestic Product, or GDP. GDP is the total monetary value of all goods and services produced within a country's borders over a specific period of time, typically measured over a quarter or a full year. It is considered one of the most important tools for assessing the health of an economy, because it shows us both the size of the economy and the pace of its growth. Now, let's explain this a little more clearly. When we say the monetary value of goods and services, what exactly do we mean? GDP is made up of four main components. 1. Consumption. This refers to the money households spend on everyday goods and services, such as food, clothing, transportation, and healthcare. 2. Investment. This refers to the spending by businesses on things that help them grow and expand production, such as building factories, purchasing equipment and machinery, developing infrastructure, and even inventories, that is, products that have not yet reached the end consumer. In simple terms, any money businesses spend to increase their productive capacity falls under this category. 3. Government spending. This includes all expenditures by the government on goods and services, such as building roads, constructing schools and hospitals, and expanding public services. 4. Net exports. This is the difference between exports and imports. If a country's exports are higher, this figure becomes positive and adds to GDP. If imports are higher, this figure becomes negative and reduces GDP. In other words, when a country exports more relative to what it imports, its economy tends to appear stronger. And because GDP includes all of these elements, it is used to measure the real growth of a country's economy. But now comes the real question. How does this indicator affect traders? And why do traders all over the world pay so much attention to it? That is exactly what we are going to talk about now. Let's start with the stock market. In general, when GDP records strong growth, most stock markets tend to move higher. When it declines, many stocks tend to fall as well. The reason is simple. Growth in GDP means that business sales are increasing, production is higher, demand is strong, and as a result, corporate profits tend to rise. And that directly affects stock prices. In short, an increase in GDP usually pushes stock prices higher. Investors also view strong GDP figures as a sign of a strong and stable economy, which increases their confidence and encourages more capital to flow into the market. The same logic also applies to the Forex market. In many cases, rising GDP means stronger economic activity and higher demand for certain basic commodities such as oil, metals, and agricultural products. For this reason, during periods of economic expansion, the prices of these types of commodities may rise. However, this should not be confused with broad and harmful inflation, because a limited increase in the prices of some commodities can be a natural result of stronger demand in a growing economy. But what happens if economic growth slows down or turns negative? Demand declines, and as a result, commodity prices may also fall. Of course, there are important exceptions. Some commodities, such as gold and silver, may move in the opposite direction, because during times of economic uncertainty, they are considered safe haven assets, and their prices may therefore rise even in periods of economic weakness. I think it is now clear why traders pay so much attention to GDP, and why this indicator always remains at the center of market attention. And with that, we've reached the end of the first video in our Economic Radar playlist. If you found this video useful, share it with your friends, and do not forget to subscribe to the channel and turn on notifications so you do not miss the upcoming episodes.